the trade that turned panic into power. It began on a morning when the world was frozen in fear. Markets trembled. Headlines warned a collapse. Investors dumped assets in a blind rush for safety. But in the middle of that chaos, one trader made a move so counterintuitive, so out of sync with the panic around him, that colleagues thought he had lost his mind. Instead, that single decision would become one of the most remarkable turns in financial history. To understand why, we need to look back at a moment when uncertainty ruled every conversation. Volatility surged. Institutions braced for impact. The air felt charged, like the second before a storm breaks. Panic wasn't just emotion, it was strategy. People sold because others were selling. They ran because everyone else was running. Fear became contagious. This story matters today because markets still behave the same way. Panic spreads faster than logic. Crowds move as one, even when the direction is wrong. And those who can think clearly in moments of collective fear often see opportunities nobody else notices. This trader wasn't fearless. He was perceptive. The first reveal begins with his unique way of studying crises. While others tracked headlines, he studied reactions. He focused on the speed of selling, the types of investors panicking first, and the assets being abandoned without analysis. In panic, he believed, people reveal what they truly don't understand. And when people flee from what they don't understand, mispricing follows. The second reveal came when he identified a particular asset class collapsing far faster than it should have. Its fundamentals were weak, but not catastrophic. The sell-off was emotional, not rational. Institutions offloaded positions not out of necessity, but out of fear of being the last to exit. The price had fallen below fair value, then below pessimistic value, then below the level at which even failure was priced in. The third reveal surfaced when he noticed something few others tracked. Large, disciplined investors weren't selling. They were quiet, waiting, watching. They hadn't moved not because they lacked information, but because they knew the market had lost its sense of scale. That silence confirmed everything he suspected. This asset was undervalued not because it was doomed, but because fear had distorted reality beyond recognition. He began tracking the sell-off minute by minute, mapping how fear flowed through the system. Retail investors dumped their positions first, then leveraged funds, forced to liquidate, then institutions under pressure from margin calls. Each wave of selling pushed the price lower, not because new information emerged, but because old fears were cycled through different hands. The asset wasn't collapsing. Psychology was. But when he shared his observations, the reaction was immediate and harsh. Colleagues warned him not to get involved. Executives urged caution. Risk officers sent cold reminders about protecting capital, not chasing anomalies. Everyone around him believed the panic was rational. Everyone but him. He saw the market's behavior fracturing from reality. The conflict intensified when the sell-off triggered automated risk models. Algorithms began dumping the asset purely because its price was falling, a loop that forced more selling, which triggered more models, which accelerated the drop even further. The trader watched the cascade unfold like a slow-motion disaster created entirely by feedback loops. The asset's value was now detached from fundamentals, driven by mechanisms designed to prevent risk, but amplify it instead. As the selling reached its peak, he examined the balance sheets behind the asset. Revenues were bruised but stable, debt manageable, cash reserves intact. Even in a worst-case scenario, the current price made no sense. It was a collapse built on emotion, fueled by automation, validated by momentum. The tension grew when major news outlets joined the panic. Reports framed the asset as the epicenter of collapse. Commentators called it toxic. Analysts predicted its downfall with eerie certainty. The negativity was so unanimous that it confirmed the trader's suspicion. The market was no longer thinking. It was reacting. Then came the moment that shifted everything. He spotted an anomaly buried in a liquidity report. A sudden, quiet purchase made by an institution known for buying only when assets reached absurd levels of undervaluation. It wasn't large enough to move markets. It wasn't public enough to spark confidence. But it was deliberate, intentional. A signal from someone who had seen this pattern before. The trader leaned in, Knowing this might be the final chance before the window closed, he didn't act recklessly. He didn't bet the firm. He built a position with surgical precision, targeting only the mispriced core of the panic while avoiding the parts collapsing for real reasons. As he executed, an uneasy silence spread across the trading floor. Others watched, unsure whether he was brave or reckless, visionary or delusional. But he wasn't guessing. He was following the data, recognizing that the moment fear peaks is often the moment value hides in plain sight. What he didn't know was that the next 48 hours would push the market into a turning point no one expected, and his decision would carry consequences far beyond profit. The next 2 days unfolded like the tightening of a wire stretched to its limit. The market's panic didn't fade, it intensified. Headlines grew darker. Analysts doubled down on catastrophic forecasts. The asset he bought into fell even further, not because new problems emerged, but because fear had gained its own momentum. It was the kind of decline that challenges conviction, even for seasoned traders. But he stayed calm, monitoring every layer of the market's behavior. He tracked order books thinning at strange hours. He noticed liquidity providers stepping back, not out of danger, but out of caution. He watched as retail forums exploded with panic, pushing each other into selling at any price. These were classic signs of capitulation, the moment when fear burns brightest before extinguishing itself. The conflict escalated when his firm's risk committee summoned him. They questioned his position. They warned that if the asset continued dropping, he would be forced to unwind at a massive loss. Their tone was clinical, but their message was clear. Reverse course before the panic consumed him. He listened, respectful but unwavering. He had mapped the psychology behind the collapse with more detail than anyone else. Nothing he saw suggested fundamentals had changed. Only emotions had. Still, the pressure mounted. Colleagues whispered. Senior traders rolled their eyes. A few tried to persuade him gently. Others mocked him openly. Isolation wrapped around him like a tightening vice. Every tick downward tested not just his strategy but his identity. Was he the one who saw clearly in chaos, or the lone fool marching toward destruction? The system reached a breaking point when the asset hit a price that made no rational sense. It traded below the liquidation value of its components, below the worth of what could be sold off in a worst-case scenario. At that level, the market wasn't just irrational, it was inverted. It priced the asset as a failure had already happened, even though the underlying company continued operating with stability and reserves. This was the moment he had been waiting for. True capitulation. Fear at maximum volume. A marketplace no longer transmitting information, only emotion. But then something unexpected happened. A halt. The exchange froze trading for the asset, citing volatility protection protocols. On the surface, it looked like caution. In reality, halts appear at two crucial moments, during the acceleration of collapse or at the very cusp of a reversal. And when he analyzed the last trades before the freeze, a pattern emerged, large institutional blocks quietly absorbing the final wave of panic selling. It was a confirmation he needed, the signal that the strongest hands in the market were stepping in, not loudly, not publicly, but decisively. When trading resumed, the asset didn't fall. It jumped. Not dramatically, but definitively. A shift in tone, a change in posture. Buyers emerged where none had been. Liquidity deepened. Panic began dissolving into confusion. Those who sold at the bottom stared in disbelief as the price recovered faster than it had fallen. The trader felt a surge of tension release, not with triumph, but with quiet clarity. His position, ridiculed only hours earlier, was now aligned with the market's turning point. The system had hit its emotional floor, and what came next would rewrite the entire narrative. When the rebound began, it started slowly, almost cautiously. A few buyers stepped in, then a few more. The asset climbed just enough to make skeptics uncomfortable. Traders who had mocked him hours earlier stared at their screens, unsure whether the recovery was a glitch or a trap. But he recognized the pattern immediately. Panic had exhausted itself, and now rational capital was returning with force. The shift accelerated when a major institution disclosed a quiet position they had built during the worst of the sell-off. It wasn't an announcement meant for the public. It was a regulatory filing, routine and unembellished. But the signal it sent was unmistakable. Smart money had stepped in when fear peaked. The market finally snapped out of its trance. The climax came that afternoon. As liquidity surged back into the asset, short sellers scrambled to cover. Orders cascaded upward. Prices leapt in sharp increments. The asset that had been written off as toxic only days earlier now tore through resistance levels in a surge that felt like the mirror image of its collapse. It wasn't optimism. It was correction. A brutal, rapid return to reality. In the chaos, his position soared. But for him, the victory wasn't a profit. It was a confirmation of a principle he had spent years studying. Panic may be loud, but it is rarely wise. Crowds react. Markets exaggerate. Fear multiplies faster than facts. And those who can hold their ground when everyone else runs often find clarity no one else can see. As the rally stabilized, colleagues who once doubted him approached with a different tone. Some congratulated him. Some apologized. Others asked how he had known. But he didn't offer formulas or secrets. He explained simply that markets reveal their truth not at the peaks of optimism, but at the depths of fear. In those moments, mispricing becomes visible to anyone willing to look past the noise. The resolution arrived quietly. His firm reviewed the trade, the models, the data, and the timing. What they found wasn't recklessness. It was discipline, precision under pressure, a refusal to surrender to collective emotion. His decision became a case study inside the firm, a reminder that panic isn't a signal to flee. It's a signal to think. Because markets will always cycle. Fear will always return, but so will opportunity. And the traders who succeed are the ones who learn to see beyond the storm, to the value buried beneath it. Sometimes the smallest shift in perspective becomes the beginning of a new future.